Hi everyone, it's Jab out with another video. Today I'm going to be talking about Roku, stuff I've been looking at for quite some time now. Streaming platform provider, a Cathie Wood favourite, stock that ran right up to nearly $500, I think it was $490 at its peak in July 2021 after a 2017 IPO. Since then the company is down 76%, worth a quarter of what it was less than a year ago, which is staggering. Still excellent hold if you've run since IPO. I think its IPO was about $20, so still up 5.5 times since then. Is it oversold, or was the valuation just out of control and the company still has room to fall? I want to find out. Roku is in the connected TV and streaming business. They produce both hardware in the form of set-top boxes and software with the Roku operating system that connects users with streaming services. From the viewer's perspective, they get all the best streaming services in one place with either a cheap set-top box or through the Roku operating system that's inside the TV. Or from Roku's perspective, they make money through selling these set-top boxes, which is relatively low margin business, not a completely ideal, very old world, why a lot of people were initially turned off on this business before getting a deeper dive. Or they get a commission for users signing up to the streaming services through the platform and now through advertising. Connected TV advertising is a rapidly growing field, and this seems to be the future of viewing for many people, viewing streaming services through the connected TV. So advertisers are really catching up on this. I think Roku is really well positioned to capitalise on this in the future. It's a strong tailwind for the company. I got this graph on Twitter, so I'll link it in the description. Excellent Twitter account for anyone who's interested. This is a graph that just shows Roku's dominance of the share of the big screen from connected TV. Roku has 31%, next closest is Amazon Fire, which obviously that's going to have a high percentage, 16.8%, nearly half of what Roku had, and both these percentages are coming down. Then Samsung TV, LG TV, Android, PlayStation, all relatively minor players compared to Roku. Roku actually has more share than Amazon, Google's Chromecast and Apple TV put together, which is incredible. Dominant position in the US market, and this will only benefit going forward. Bit concerned that viewing time is coming down, that share that is coming down over time as a share of viewing hours, but I'm not overly concerned about this. If I see any bigger declines, if it drops down into the 20s, then I'd be a bit more worried. Taking a look at the balance sheet, it looks in pretty good nick to me. Cash on the balance sheet of $2 billion compared to around $500 million in debt gives a decent cash debt ratio of 4.11, decent position as far as I'm concerned. Debt to EBITDA is okay again, fairly well covered at 1.67. Excellent interest coverage, 78 or something ridiculous. Fairly good interest coverage. Almost score of 9.83 indicates this company is not at risk of near-term financial default, as you'd expect, and has enough cash on the balance sheet to fund its growth, as well as its now turning profitability. So this is a strong position for the company moving forward, as it's kind of moving out of that permanent unprofitability stage. Now it's recording profits and it's still growing. More ethical growth in my opinion. Return on invested capital is impressive at 23.58%. If it carries on this for a good length of time, as Charles says, this will be a great investment almost regardless of the price. This company is still very much in its growth phase, and margins reflect this. Gross margin of around 50%, but operating margins and net margins around 8.5%. Early days of profitability, not expecting a lot from this right now. These margins will improve as the business becomes less about selling set-top boxes and more about that advertising spend, more about the money from the streaming services. So we'll see this change over time as the streaming platform becomes a larger and larger percentage of revenue. It's already quite a large percentage of revenue, but I think these net margins will come up over time with this. As a whole, will return on equity percentage and return on assets, which are both at the low end of where I would like them to be at the minute. Overall, I think the margin profitability picture is decent, and I think the balance sheet is pretty good. Look at the valuations. It's no shock that a company that is worth a quarter of what it was a year ago looks very cheap versus historical comparisons. Roku is always traded at a relative premium. Price to earnings ratio of 68 is obviously a very large multiple. This is primarily due to the early stage profitability of this company. It's very good versus the history because it's pretty much it's that early stage profitability that any PE ratios that were recorded previously will have been in the hundreds or thousands. The company has 50% gross margins, so in the not too distant future, these multiples should compress greatly if the price remains roughly the same. Price free cash flow, again, very large at 88 times. These multiples imply high growth expectations are priced in, which of course Roku has done previously, grown at 55% this year. Price sales ratio of now 6 is the lowest I've seen in a very long time, pretty much since this company's IPO. A hard company to value as the market is treating highly valued companies very harshly, and while these metrics are fast coming down, starting to look quite rich, still look quite rich on the surface. P ratio of 70, The company's predicted to grow at 30% this year with a 50% gross margin. It's kind of a SaaS valuation without the SaaS margins, in my opinion, and with a lot of challenges. So we'll see how this affects it. Q4 disappointed Wall Street expectations, and we saw that with a massive stock drop on the day. It was already getting beat up pretty badly, but I think it went down to over 20% in a day on that news. But the year as a whole, pretty good in my opinion. 55% year-over-year growth in revenue to now 2.76 billion. Still at the early stages of monetization in a lot of the business, so this is very strong. Active accounts up to 60 million. They now predict that this is more than the cable subscriber base in the US. Very good. Average revenue per user up 43%, which is way outstripping user growth to now $41.03. It's a pretty high value per user. User growth is not quite stagnating, but it's definitely coming down from what it previously was. Active accounts is barely grew this year, up 17%, whereas ARPU is up 43%. They're going to need to push that average revenue per user and continue to push it up. They're now the number one TV stream platform in the US, Canada, and Mexico by hours streamed, and it doesn't look like they're giving this up anytime soon. Graphically, I think it's a lot easier to see how well Roku has done and how quickly this scale has been achieved. They've tripled users since 2017, and platform revenue is up 10 times since 2017, which is absolutely excellent. Revenue is predicted to continue to grow at the mid-30s percentages all next year. Clear deceleration from the growth is now, which is probably what got Wall Street so spooked. But to be honest, like, the company isn't as richly valued as it was, so this is not that big of a deal. And also, growth is harder to achieve when you're already the market leader and you are clearly reaching North American user saturation. Key thing for me going forward is they need to grow that user base and that average revenue per user internationally. Users internationally are worth far less than US users, as we see with many social media networks like Pinterest, Facebook, blah, blah. International users always bring in far less revenue. We need to see that ARPU go up for international users, and we certainly need to see the international user base grow because it's a very fragmented market and Roku does not have that lead that it has in North America. Partnerships are absolutely key for this business. They just secured a deal with Amazon for a multi-year extension to keep Prime Video and IMDb TV on Roku. The competitors for Roku, it's a wide landscape of competitors, and there's some really big players there. Google, Amazon, Apple. Roku has built up a little bit of a moat with the platform and OS, but consumers are fickle and they really need to keep these competitors on side because Amazon could essentially give out Fire Sticks for free and no one would bat an eye. If the streaming services refuse to interact with Roku, they could be left badly out in the cold. Maybe say if Amazon Prime decides not to be on Roku, that isn't the end of the world. But if Netflix does it, then you start to question that. If Disney does it, maybe you start to question it. And if multiple do it, then maybe Roku will start to lose users. So keeping these businesses on side is absolutely key, which might not always be so easy considering there's such big competitors. Streaming services nearly all owned by giants who could quite easily go out on their own. And also the consolidation in this industry is a little bit concerning. If instead of, I don't know how many streaming platforms there are now, but there seems like another one popping up every day. If instead of this it goes down to maybe 5-6 big names, then some of these can go out on their own, have exclusivity deals, say Amazon is only on Fire Sticks, for example. This makes life a lot more difficult for Roku. Overall, I like the Roku business. I think they have great tailwind. Connected TV looks to be the future of TV and streaming, and Roku is well positioned to capitalise on this. I think right now they have a good handle on the competition and are managing relationships well to keep the lead in North America. Not sure how much moat they have, only time will tell, as the market share lead definitely says something. They have a double market share lead over the competitor with 30%, way higher than anyone else in North America. Maybe this lead says something that I'm not seeing, but I don't see any real moat here. Valuation has shot down. The company is clearly a better deal now than it was a year ago. That being said, I don't think it's dirt cheap, and it doesn't have SaaS gross margins, but kind of trade like a SaaS company. I think the business is nice, and I would be happy to buy, even if I don't think it has incredible moat. I'd like to see the earnings multiples come down and the company to make progress internationally, if I can see this as an attractive long-term investment. And I want to see it continue to keep up these partnerships with businesses. So I'm not buying right now, but I'm keeping a much closer eye on it after digging a bit deeper. I'm still not sure about the moat, but I think this is a great business that, despite tons and tons of competition, is holding it off well. I'm just not sure how it's doing internationally. I'm not seeing anywhere near as much of an uptake internationally as it has in North America. Of course, none of this is financial advice. You should do your own research and due diligence. And importantly, tell me what you think of Roku in the comments section below, and tell me if you're enjoying the video. Any feedback is appreciated. Like and subscribe if you're enjoying the content and you want the channel to grow. I'll see you again next time.